The latest data from the Moody's Real Commercial Property Price Index suggests that the precipitous decline in commercial real estate values may be slowing. The index dropped 1% in June, compared with declines between 7 and 9% in the previous 2 months. We're joined on the phone by Neal Elkin, president of Real Estate Analytics LLC, to discuss the latest results. Neal, many observers are taking these to be good signs. What do you think?
It's dangerous to get all excited about that, given that it is just one observation. The one interesting aspect of it that I think does give us some increased comfort is that slower deterioration, from 7.6 in May to 1% decline in June, was done in an environment where we saw the number of observations rise significantly. And not just the number of observations, but the volume behind those observations. It wasn't just a lot of really small deals, but the dollar value of those pairs of transactions also rose significantly from May to June. So in an environment when you've got rising transaction volume and slower deterioration in prices, it sort of gives you a little bit of comfort. But again, I caution it's 1 month's observations. So you have to be careful about sort of jumping on a new recovery bandwagon, but it's clearly better to see that than something, with an accelerating deterioration on the downside.
Neal, the office sector has struggled mightily during this downturn, but we saw somewhat of a bounce back in June. What do you think about this?
It's an interesting question. We've got a lot of inquiries about our national office being up 4% over the second quarter, and whether that's a sign of something deeper going on. That property type fell an enormous amount in the first quarter, and I think that what we're seeing now is just the realization that may have moved a little bit too far, a little bit too rapidly in Q1, and there's been some bounce back.
Neal, your index breaks the country down into MSAs, which refer to different metropolitan areas. Have you seen any differences in how the major and more secondary markets have performed?
Since 2006 and 2007, in a search for yield, there was a lot of capital that was seeking secondary and tertiary market assets because you got enhanced yield on that, and we saw spread compression across those markets that, in hindsight, was a little bit reckless. And in the first quarter, we said, look, we're seeing some return to this because those are the markets that have shown to be more vulnerable. While the top 10 MSAs by property type were, for each property type, outperforming secondary and tertiary markets. In this most recent quarter, that theory has been thrown out. And we're now seeing, really consistent poor performance across primary, secondary, and tertiary markets. So the weakness has worked its way into even what I would have considered 3 months ago safe markets.
And what's been the biggest surprise of all the trends that you've observed?
Really, the most surprising thing is how consistent the deterioration has been. Really, across property types, across the top 10 MSAs, again, across very, very little differentiation. It's just been really weakness across the board.
Thanks for joining us, Neal. For more information on this and other REIT news and analysis, check out REIT.com.